Dreaming of raising capital but don't know what investors really want? Today, we're breaking down what it takes to be investor ready, from crafting a pitch to closing the deal. Stick around, because these insider strategies separate funded founders from the rest. Hit subscribe and let's get started. Understanding investor expectations. The first step in raising capital is understanding what investors look for. Investors seek returns, of course, but more specifically, they want to see a scalable business with a strong value proposition, a capable team, and a clear path to profitability or exit. They ask questions such as, is the market large enough? Can this business grow quickly? Do the founders have the skills and commitment to execute? Understanding these expectations helps founders focus on what matters most, demonstrating traction, strategy, and potential. Being investor-ready is about aligning your vision with the investor's objectives, crafting a compelling vision and story. Investors invest in people as much as in ideas. To attract capital, you must craft a compelling narrative about your business, your mission, and your growth potential. This means articulating the problem your business solves, the market opportunity, and why your team is uniquely positioned to succeed. Storytelling is not fluff. It's a strategic tool that helps investors visualize the upside. A founder who can clearly explain why their company matters, how it will grow, and what the future looks like will always stand out from someone who only presents numbers. Building a strong business model and traction. Capital is rarely given based on ideas alone. Investors want evidence that your business can generate revenue and scale. Demonstrating traction through sales, partnerships, user growth, or recurring revenue is critical. A solid business model shows how your company makes money, who your customers are, and why the revenue stream is sustainable. First-time founders often underestimate this step, but investors need proof that their capital will be used wisely and that your business has the potential to deliver significant returns. Preparing financials and metrics. Financial transparency and accuracy are non-negotiable. Investors scrutinize historical financials, projections, and key performance indicators, KPIs. This includes revenue, gross margins, burn rate, customer acquisition cost, and lifetime value of a customer. Being able to explain your numbers clearly and confidently is crucial. Investors need to trust that you understand your business inside and out, and that the financials tell a realistic, credible story. A founder who can walk an investor through their numbers with confidence signals competence and readiness. Building the right team. No investor will bet solely on a single founder, no matter how brilliant. Your team is a key factor in raising capital. Investors look for complementary skills, experience, and the ability to execute under pressure. Highlighting your advisory board, key hires, and team expertise adds credibility. A strong team signals that the business can withstand challenges, scale effectively, and deliver on promises. Founders who demonstrate that they surround themselves with capable people are far more likely to attract serious investors. Crafting a pitch and presentation. Even with traction, numbers, and a strong team, raising capital requires the ability to communicate effectively. Crafting a professional, concise, and compelling pitch is essential. This includes a clear problem statement, market analysis, business model, financial overview, growth strategy, and exit opportunities. Visual aids, storytelling, and a polished presentation can make a significant difference in investor perception. Founders must practice their pitch until it is smooth, persuasive, and adaptable to different audiences. Confidence, clarity, and authenticity are as important as the content itself. Networking and finding the right investors. Raising capital is not just about pitching, it's about relationships. Networking and finding investors who align with your vision, industry, and stage of business is critical. Approaching the wrong investors wastes time and often leads to rejection. Successful founders identify investors who have experience in their market, share their long-term goals, and understand the business model. Warm introductions, industry events, and mentorship networks can open doors that cold outreach often cannot. Cultivating relationships before asking for money increases credibility and trust. Navigating term sheets and negotiation. Once investors are interested, negotiating terms is the next critical step. Term sheets outline the investment structure, equity ownership, valuation, and rights of both parties. Understanding these terms and knowing when to negotiate is essential for protecting your business while remaining attractive to investors. First-time founders should seek legal counsel or experienced mentors to ensure they are not giving away unnecessary control or taking on unfavorable terms. Negotiation is not just about money. It's about building a partnership that will support the business long-term. Due diligence and transparency. After a term sheet is agreed upon, investors conduct due diligence. This involves verifying financials, legal documents, intellectual property, customer contracts, and operational processes. Being transparent and organized during this phase can accelerate the investment process and build trust. First-time founders who anticipate due diligence requirements and prepare thoroughly are far more likely to close deals efficiently. Transparency demonstrates professionalism and signals that the business is well managed and ready for investment. Post-investment execution. Raising capital is only the beginning. Once funding is secured, investors expect founders to execute on their plans, hit milestones, and provide regular updates. The real test of being investor-ready is the ability to deliver results, manage the business responsibly, and create the value that was promised. Investors are partners in growth. Successful founders maintain strong communication, leverage investor expertise, and focus on measurable outcomes. Execution is what turns investment into traction, growth, and long-term success. What it really takes to raise capital. Being investor-ready is more than just having an idea or a business plan. It requires preparation, professionalism, strategic vision, and execution capability. First-time founders must understand investor expectations, craft a compelling narrative, demonstrate traction, maintain financial transparency, build a strong team, deliver a persuasive pitch, network with the right investors, negotiate effectively, and execute post-investment. Raising capital is a skill that can be learned, and those who approach it strategically have a significant advantage. For founders ready to scale, secure funding, and grow their business, mastering the investor-ready process is the gateway to success. That's what it really takes to raise capital and get investors on board. If you found this valuable, hit like, comment your biggest takeaway, and subscribe for more proven strategies that turn ambitious founders into funded founders. Now go out there and make it happen.